This is Doug Morin. Thanks for joining in. We're talking about my favorite topic, which is index universal life insurance. And more specifically, in this webinar, we're going to be talking about the loads, fees, and charges associated with index universal life. If you look at the sales industry-wide, in the annuity side, they're flattening or going down. In pretty much all product lines, they're going down, except for index universal life. Index universal life has had explosive growth in especially the last 5 years. And, the product has only been out for about 12 years, and it's been gaining momentum. But the last 3, 4, 5 years, it's like doubling. The sales of the product are doubling. A couple of years ago, we only had a couple of carriers that had index universal life products. Now, I don't know, there's probably 30. And from what I hear, there's about 60, 70 companies that are just getting ready to release their index universal life product. They're doing this for a reason, man. It's because they know what's going to happen. This product is very popular and will become even more and more popular. What you'll find is it's a lot of fun to sell. It's a lot of fun to talk to people about. And it really is one of those things that when you get done, you really feel good about what you did for your clients. And another thing that you'll do is the more you get into this product, this index universal life product, you will be buying it for yourself. You will be putting your money in this product. And if you aren't, you shouldn't be selling the product. That's probably true of any product. But if you don't, once you get familiar with the IUL product, if you don't feel like this is the best place I can put my money, bar none, then there's something about the product you're not seeing. Okay, having said that, index universal life, the session today, we're going to be going through the loads, fees, and charges of index universal life. This is extremely, extremely important because if you're positioning an IUL product as an alternative investment, as a wealth accumulation vehicle, or we're not so much positioning it as a traditional life insurance product, but we're saying this is the best place for you to put your money, to keep that money safe, to grow that money, and to ultimately get tax advantages on that money. If we're positioning that way as an alternative investment, the loads, fees, and charges are something that we really need to spend a lot of time explaining to our clients. And in fact, most clients will demand an explanation of loads, fees, and charges. One of the things I think that's important to keep in mind is that the attitude that's out there, that's entrenched in the minds of the people we're trying to get as clients, is typically that life insurance is not the place that you put a lot of money into as an investment. The media, and a lot of disinformation, a lot of bad information, but whether it's right or wrong, the information that's been out there has been telling people for years, don't use life insurance as an investment. And if you look at any of the commentators in the media that advocate not using life insurance as an investment, their reasons are always pretty much the same, which is you don't want to put a lot of money into life insurance and figure that it's going to perform as a good investment because the loads, fees, and the charges are too high in life insurance. That's always the reason that they give. So if that's in the client's mind, unless you can change that attitude, you're going to have a difficult time getting that client to do what you want them to do. And I don't think you can change that attitude without having a very honest and frank discussion of what the actual loads, fees, and charges are in index universal life. People often ask me, agents often ask me, well, how come you're always talking about index universal life? Does that mean you don't like whole life? You don't like other forms of insurance? And the answer is no, that doesn't mean that at all. And I hate it when we in this industry get into these pissing battles of which is the better product. It doesn't do us any good. It doesn't do our clients any good. The right way to look at this stuff, in my opinion, is that these are just tools. These are just tools, whether it's index universal life, whole life, whatever, it's a tool. And it's a tool that's going to be more or less appropriate to use in a given situation. As advisors, as agents, we have a lot of tools. We have access to a lot of tools. you pick tools to do a good job or a certain job. What's the job that I'm trying to do for most of the people that I'm talking with? Well, most often that job is I'm trying to get them a higher distribution. I'm trying to get them as much distributions at retirement. I'm trying to create an income stream for them at retirement that can be as much as I possibly can get them without too much risk. That's what I'm trying to do. And if that's the objective, then I think you got to recognize that there is an upside potential with Index Universal Life that you typically don't have in other products. There is an upside potential in Index Universal Life, but we still have protection up against downside risk. And I think it's a product that is appropriately suited for a great number of people that are both risk averse, but who also desperately are going to need larger streams of income at retirement to be able to live the kind of life that they're going to want to live. So I think Index Universal Life is a really good product, a really good choice in that situation. Another reason that I like Index Universal Life is as it relates to the loads, fees, and charges. And that is that it's totally transparent. As a life insurance product, that is unique. When we print out an illustration for our clients, we can print out every illustration software I've ever seen that allows you to do IUL illustrations. Will also allow you to print out a cost report. And the cost report will break down to the penny all of the loads, fees, and charges in the policy. So if you're gonna explain the loads, fees, and charges to your client, you can only do it with the UL product. You can't explain the loads, fees, and charges specifically of a whole life or more traditional life insurance product because they're nowhere for you to see them. You can't see what the loads, fees, and charges are in a whole life product. Does that mean that a whole life product is not good? No, it doesn't at all. The whole life product is a tool. You use that tool in certain situations. The IUL is another tool. One of the reasons I like it so much is because there is total transparency of those loads, fees, and charges. When we're talking about the cost of insurance, when the financial entertainers in the media say, don't use life insurance because the loads, fees, and the expenses are too high, how do we combat that or how do we deal with that? Well, I think, first of all, we can't deal with it in a vacuum. In other words, we can't, the best way to deal with it is, well, yeah, life insurance is expensive, but compared to what? What are we comparing this to? Because everything is expensive. Some things are expensive because you got to pay taxes on them. And when you're looking at the potential of the government taking 30 or 40% of the growth, that's really expensive. I can deliver something to my clients with a life insurance contract where they can avoid the taxes on that growth. So that alone is going to offset a great deal of expense. So my point really is that when we're dealing with the issue of loads, fees, and charges, when we're dealing with the issue of life insurance and the expenses associated with life insurance, we have to compare that to something else, if for no other reason than just to get a perspective on those loads, fees, and charges. So what are we going to compare this with? Well, what do most of our clients have? What's the common thing that most of our clients are putting money into right now? Well, most of them, or a lot of them, it's a 401k or a 403b or 457 plan, some kind of qualifying plan. And I think the statistics are there's a lot more money in 401k. So let's compare it to a 401k. And usually with the 401k, you have the administration expenses of the 401k plan itself, but then in addition, there is some kind of investment within that 401k plan. And often a common investment in a 401k is a mutual fund or a choice of mutual funds. You really have two layers of expenses with a 401k, the plan expenses and then the expenses of the investment vehicle within the 401k. So what are those expenses? Well, do a Google search, search for 401k fees, and then add to that New York Times, and you'll I believe you'll come up with a link to an article that's a great article to share with your clients. It appeared in 2011, June of 2011, but it's still relevant. And basically what they did in the article is they went through and came up with average expenses or fees of 401ks. And they broke those expenses down by the size of the 401k. So if your client happens to be with a large employer that has a big 401k plan, chances are they won't be paying as high of expense in their 401k as if they were an employee participating in a smaller plan. But the numbers broke down in the way you see on the screen. For plans with $100 million or more of assets, the average fees were a little more than 1%. If the plan was 10 million to 100 million, the average fees were about 1.33. And then for plans, smaller plans under 10 million, the average fees were a little below 2%. Well, let's just kind of average all that together and say we're dealing with a 1.5% load fee charge, whatever we want to call it, on that 401k. Well, now we got something to kind of compare the cost of insurance to. 1.5 on the 401k, and then the fees that we'll get into on the IUL side. Before we do, let me give you just a quick little kind of a napkin presentation that can be, you might find to be effective to use with your clients, just to put this into perspective of all of the costs associated with their 401k or alternative investments as opposed to what you're proposing. And I learned this actually from an old annuity guy, and it was a great annuity presentation. It was a great presentation to use with indexed annuities. And I found it's even a better presentation to kind of explain the value proposition of an IUL versus something else. So here's basically what you would do if you wanted to do a yellow pad or a napkin presentation. You would just start by drawing a line in the middle of the page, draw a horizontal line across the middle of the page. And then what you'd say to your client is that, okay, look, what you currently have, let's say it's a 401k. You currently have this 401k. You've got money in your 401k, and it's invested in the stock market via the mutual funds inside the 401k. And let's say the stock market goes up in a given year. You would draw a rectangular box above the line, as you see here on the left side, and label it, market goes up, and then you say, let's say it goes up 10%. Okay, what do you really get out of that 10% when the market goes up? Well, if your load or your fees associated with your 401k are 1.5%, you get the 10, but minus 1.5%. So really what you get net is you get 8.5%. That's when the market goes up. Problem is you really don't get that full 8.5% because the one thing that we are not factoring into this is taxes. You're currently postponing not only the payment of the tax, but the calculation of the tax until some future date, which of course is at retirement. But at some point, you're going to have to pay taxes, and the taxes alone are going to eat up a certain portion of that growth. We don't know what that's going to be, but generally speaking, if we were assuming that it was going to be 30% or 25%, the net of what you're going to receive after taxes is not going to be the 8.5. It's more than likely going to be 6.5, 7%. That's your net growth, net of tax, net of expenses in your 401k. So really what's happening is you're only capturing 65% of the upside by the time you factor in expenses and taxes. That's when the market goes up. What happens when the market goes down? Let's say in a given year, the market goes down 10%. Well, does your 401k mutual fund, does that not charge your fees? Is there a provision in there that says when the market's down, you don't pay any of these fees? No. You're paying those fees whether the market goes up or down. And if those fees are 1.5%, when the market goes down 10%, what you actually lose is 11.5%. So the value proposition in your 401k is basically this. When the market goes up, net of expenses and net of taxes, you maybe are collecting 60, 65, 70% of the upside. But when the market goes down, you're hit with the full 115% when we assume a 10% market loss and an additional 1.5% in loads, fees, and charges. So that's your value proposition. When the market goes up, you're getting hit pretty hard. When the market goes down, you're getting hit even harder. Now let's compare that to value proposition and what I'm proposing. And this is, this is just a general conversation, but as long as our cap rate is greater than 10%, it applies. So what we're saying is that if the stock market goes up 10%, if I can structure the IUL so that we're keeping the fees over the life of the IUL to where they're going to average about 1% per year, then basically what you're going to net when the market goes up 10% is you're going to net 9%. Now, the great thing is, if we handle this contract properly, you don't have any taxes to pay. So that full 9% can be yours. That means that you're capturing 90% of the upside in the market. But even better, let's look at what happens when the market goes down. Because of course, as we all know on this call, our indexed products are protecting the client from market losses. You still have the ongoing expenses of insurance and an IUL, but when the market goes down 10%, you don't see your cash value decrease by 10% because it's protected from those market losses. You still have the expense, but if we've kept that expense to 1%, then when the market goes down, that's what you're getting hit with. So the value proposition within the IUL is quite a bit different. Market goes up, we're capturing a large percentage of that upside. When the market goes down, we are limiting the loss on the downside to just whatever the expenses are in the insurance contract. So that's a little bit of a presentation. You can do it in a couple of minutes just to kind of put a perspective on this. That presentation dealt with a theoretical of if the market goes up, you get goes up 10%, you get the 10%. But the reality is, and I know a lot of you know this on the call, the reality is most mutual fund investors, most stock market investors, they don't do nearly as well as what the index returns over time. You can do another Google search for the Journal of Pension Benefits. This particular issue was autumn of 2008. And in this issue, what it shows is what investors actually capture of the stock market returns. And in this particular issue, the reason I like this issue is that it's showing those returns and what investors actually captured from the 20-year period between 1988 and 2007. I like to look at this because everybody knows that the stock market melted down in 2008 and 2009. Everybody knows, yeah, that was a bad time to be in the market. Most people think prior to that, it was a great time to be in the market. And it would have been because as you see the bar all the way on the left, what stocks did over this 20-year period was the average annualized return, or I shouldn't say average, the annualized return over this 20-year period was 11.81%. So theoretically, if you were invested in stocks over this period, you should have gotten a double-digit return. But the reality is the average investor, according to the the Journal of Pension Benefits, the average investor that was invested in the stock market actually only got 4.48%. That's the person with money in the stock market, even during a 20-year period where the annualized return was almost 12%, the typical investor, average investor, their annualized return from a stock market investment was only 4.48%. That's less than if they had their money in T-bills. What's the difference? Why did they only get 4.5% when the stocks were going up 12%? We all know the reason, or most of us know the reason. Most people are lousy stock market investors. They're lousy stock market investors is because their emotions get in the way of their best interest. Most people, they sell when stocks are low. They buy when stocks are high. It's the opposite of what they should be doing, but it's human nature. When the bottom's falling out of the market, people scramble and they sell their holdings and they start buying back when the market is recovered and is doing really, really well. And so they never really experience those long-term gains that the stock market can provide. So if we were going through that exercise of here's what happens if the market goes up 10% or down 10%. Well, the reality of it is most people don't get the full 10% anyway because they're just not good investors. Of course, our indexed product allows people to be good investors because when the bottom's falling out of the market, we've protected them from market losses, so they don't have to jump out at the right time. They don't have to jump in at the right time. They can just stay in. They're protected from the downside, but they participate in a good chunk of the upside. You guys all know that story, but it really is important in this context. Okay, let's get into the actual numbers, an actual illustration, which is what you're looking at. This is an illustration run on one carrier's product. Doesn't make any difference who the carrier is, because what you're going to find is that all these products pretty much have the same categories of loads, fees, and charges built into their products. There may be differences in the amounts, but they all basically approach this the same way in terms of charging loads, fees, and charges on these contracts. Notice in this particular contract, in this illustration, what we're doing is we're funding this policy over a 5-year period of time. This particular policy is designed to hold $250,000. And we're feeding that $250,000 into the contract as early as the MEC rules will allow, which at this person's age happened to have been 5 years. So we're putting $250,000 in, we're putting it in over 5 years, and the way that we're structuring the product, we're really setting this up as an alternative investment. The client's doing this because they want a safe place to grow their money. They're not doing it primarily for life insurance. So we're getting the minimum death benefit that we can get based upon that premium that the client's paying in. In this case, that minimum death benefit, you see the column on the right, is $930,000. There's 3 categories of expenses associated with this particular product and all products. And those 3 categories are the premium load, the cost of insurance, which is also referred to as COIs or mortality charges, and then kind of a catch-all category that I'm calling other. And this would include things like the policy fee and the per thousand charges. Those are the 3 major charges in a policy: premium load, ongoing cost of insurance mortality charges, and the per thousand charges. So we're going to take a look at each one of them. Starting with the premium load. Premium load is a flat charge against the premium as it's paid into the policy. Your client sends the client sends the insurance company $10,000. They pay a $10,000 premium payment. Right off the top, that insurance company is going to deduct the premium load. All companies can charge different amounts of a premium load. What you typically see is a range from a load of 5% on the premiums to maybe as much as 10%. In most of the contracts, they're going to fall in that range of 5 to 10%. So if a product had a premium load of 6%, as the client paid in the $250,000, which we're assuming in this example, we know that 6% of the $250,000 right off the top is going to be taken by the insurance company. It's taken as that premium payment is paid in. So this premium schedule was $51,464 in the first year. 6% of that is $3,087. That's the load that's coming out. Second year, client pays another $51,000. Second year, the insurance company's taking another $3,000, and so on. In the 5th year, The premium changed a little bit, and now the premium payment is $44,000. 6% of that is $2,600. If we structure this contract so that the premium payments are done at the end of 5 years and the client doesn't pay anything else in, the premium load stops. It's only charged against the money, the premiums that the client pays in. If you structure a contract so that the premiums will be paid over a 20-year period, every time the premium is paid, the insurance company is going to take that load, that percentage load, and deduct it from that premium. Whether the client crams all the premium payments into the policy in the first 5 years, or 10 years, or 20 or 30 years, generally speaking, it doesn't really matter. If the premium load is 6%, it's going to be 6% of what they paid in over 5 years, or 6% of what they paid in over 10 years, or 6% of what they paid in over 20 years. But once those premium payments stop, the premium load stops as well. The next category of charges, cost of insurance, COIs, are again what often is referred to as mortality charges. In your cost report, you'll see a breakdown. This is just what we're looking at as a cost report on a particular product. And again, look in your illustration software, usually under like supplemental reports, you'll see a cost report. You just click that button, and when the illustration prints out, a cost report will be printed out with it, and it will show all the breakdown of all the charges. And one of the columns, it will show those mortality charges, the cost of insurance. So these would be the mortality charges on this particular contract. And basically, all of the mortality charges from all the insurance companies charge are based upon the Commissioner's Standard Ordinary Mortality Table. But insurance companies discount the mortality rates that they are using in their products, and they discount it for competitive reasons. So they have the ability to charge less than what's on that Commissioner Standard Mortality Table. They can't charge more than that. The mortality charges are going to continue for the life of the product, because there's always going to be a life insurance death benefit. Unless the product endows, there's always going to be a life insurance death benefit in the product. And as long as there is a net death benefit in the product, there will always be a charge that's going to come out of that. It's going to be charged against that cash value to cover that death benefit. Then the other category of expense would be those per thousand charges and the policy fees and anything else. In this particular case, the policy fee was $72 a year. Add to that the per thousand charges. And what you'll see when you look at different policies, different IUL policies, you'll see some policies that charge a per thousand charge for a period of maybe 10 years. And you'll see other policies that'll charge a per thousand charge for a period of 12 years, a period of 15 years. It can vary from product to product. In this particular example, the per thousand charges are charged only for a period of 10 years. So what we're seeing here is a large charge for 10 years, and then it drops down to $72 in the 11th year. Why does it drop down? Because that's just the policy fee. So the per thousand charges stop. The policy fee is going to continue typically forever, as long as the policy is in force. So the per thousand fees are generally hit upfront in the life insurance contract. The way I look at it, it's not actually an accurate way to look at it. I don't think mathematically it's accurate, but in my mind, I just kind of look at it this way. All the marketing expense, the commissions that are paid, what's going to our uplines, what's being paid to our FMOs, IMOs, and what we're getting, that's coming out of those per thousand charges. Again, that's just the way I look at it. Life insurance company, they're maybe making a little on the per thousand charges. They're making a lot on the premium load. They're making money on the mortality charges. There's a lot of ways for the insurance companies to make money in the IUL contract. Is that good or is that bad? Well, it is what it is. But from one standpoint, it's good. And this is what I mean by that. Annuity agents are asking all the time, why are our caps so low in these annuity products? Why is it that, and this is a great question too, how is it that a life insurance company that has a fixed indexed annuity product where the cap rate is only 4 or 5%, how can that same insurance company have a fixed indexed universal life product where the cap rate is 14, 15, 16%? On the surface, it seems like something's wrong here. Well, the reason that the cap rates are so low today on our annuity products is because the life insurance companies only have one way to make money on an annuity contract, and that's the spread. The difference between what when they take the client's annuity premium and they invest it and they earn interest on it, what they earn versus what that contract guarantees to the client is the spread. In a low interest rate environment, which is what we've been in now for years, there is not a very big spread in that product. And that's the spread that the insurance company has available. I mean, think of what the insurance company has to do with that spread in the annuity contract. They have to pay us our commission. They have to make a profit so their stockholders are happy. They have to pay all of their expenses. And then with what's left over, they got to go out and buy the call options, which support, I shouldn't say call options, but the derivatives that support the caps in the product. And when you're dealing with an annuity, since there's only one way for the insurance company to generate revenue, and that's that spread, in a low interest rate environment, there's not a lot of money there to go out and buy those derivatives, those call options, to give us the caps that we'd like to have. That's why our caps are so low. When you look at a life insurance contract in comparison to an annuity contract, on the annuity side, we're used to saying to our clients, there's no sales charge, there's no loads in your annuity contract. In other words, you give us $100,000 to put into the annuity, that $100,000 is all going to work for you. There's not anything deducted out, there's not a load deducted out, and that's true. And perhaps that's an advantage, except it's also why the caps are so low in the annuity products. An IUL product provides the insurance company with multiple ways to generate revenue from that contract. There is more money in the IUL contract for the insurance company to go out and buy the derivatives, the call options, so that it can support those higher caps. So I think it's a mistake to look at the higher caps in IULs. I know some agents are suspicious and they look at it this way. Oh, they're just kind of teaser caps and they can't possibly afford to offer a 14% cap, 15% cap, and they're going to come down. Well, they may come down. If they come down, they're going to come down for market reasons. They probably will come down in our current environment. But it's my belief you'll always see a much higher cap on an IUL product than you'll ever see on a indexed annuity product. And it's simply because there are more revenue sources, loads, fees, and charges in the IUL product. Okay, so those are the per thousand expenses. Let's total them up. Let's total up our loads. Let's total up the mortality charges. And let's total up the per thousand charges and policy fee and everything, all the fees, charges. In the first 14 years, in this particular policy, here's what we're looking at. Starts out $9,100. At the end of 14 years, it's dropped down to $770. What this should show you and tell you is these are front-end loaded products. An IUL product, the charges are heavily oriented in the front end of the contract. Why is that important? It's important for a number of reasons, but the main reason is none of our clients have any business putting money in these contracts if their intention is to pull the money out early. Let me say it this way. Our clients don't have any business putting money into these contracts if their intention is to cancel these contracts or to pull the money out of the contracts without the intent of paying that money back in. Now, here's why I say that. If you've got a client that puts money into an IUL and they're doing it perhaps because 10 years from now, 20 years from now, 30 years from now, they want to retire and they want to take an income stream, this is a great product for it. But what if they need the money to do something else before retirement when they need the income stream? They put the money in, an emergency comes up, a business opportunity comes up, they want to buy a car, they want to pay tuition for a college education. Can they, should they pull the money out of the IUL contract for that purpose? And if they do, what's that going to do to the retirement income that was the original reason that they funded this contract? It's a real important point. As long as they pay that money back into that policy, it will not impact their retirement income stream in the future. And there's no problem, in my mind, with pulling money out of the contract early in the contract to buy a car or to pay college expense or to pay for a business opportunity. As long as the plan is to pay that money back into the policy, because if we do it that way, it will not interfere with the retirement income stream, which was the primary reason that the client was doing this. If, though, the client is, let's say you've got a client that's 60 years old, and they got a lot of money, and you're talking to them about putting the money into an IUL to generate a tax-free retirement. And they want to start that tax-free retirement at age 65. They're currently 60. They want to start the tax-free retirement at 65. Is the IUL going to be a good product choice for them? And the answer is no, it won't be. And the reason it won't be is because it is a front-end loaded product. There are costs that are coming out of this product that it's going to take time for the policy to overcome those initial costs. It's going to take time for the cash value, the remaining cash value, to grow in the contract so that it can actually perform well as a vehicle to generate retirement income distributions for the client. And 5 years is not enough because of those front-end loads. General rule of thumb in my mind is that if I've got a client that's going to need to start taking money out of this contract with no intent of paying the money back, that's the distinction. And when somebody takes money out for retirement, they don't have an intention of paying it back in. So for me, the general rule of thumb is, if I got a client, they're going to need this money for retirement income before 10 years is up, sell them an annuity. You're doing a better job for them. If you've got a client, though, that isn't going to need to turn that income stream on, and ideally it'd be 12 years, 13, 14, 15 years. This is a great product, and I don't care how old the client is. You get a lot of agents new to IULs, and they'll say, oh, yeah, I really like this IUL product. It's a great product, but my clients are too old for it. That is a wrong way to look at it. It is not how old your client is that should be the determining factor in the appropriateness of an IUL. It is instead, how long does the client have before they're going to need to access those cash values? And I'll tell you, if you got a client that's 35 and they need to start accessing cash values with no intent of paying those cash values back in 5 years, the IUL isn't going to be any good for them. If you've got a client that's 75 and they're not going to touch these cash values for 15 years, if at all, I don't think there's any better place for that client to put their money, especially if that client is the least bit risk averse. So stop thinking in terms of age and start thinking in terms of how long is the money going to stay in here. And that's your determining factor. So at any rate, when we look at this, a couple of things to point out. We see that the charges in the first 10 years are, relatively speaking, are high, $9,000, $7,000, $8,000. And then there's a significant drop off from the 10th to the 11th year. It goes from $8,000 to $2,000. Why the large decrease? Why are we seeing this big drop off? Well, if you remember, the premium loads are coming out, well, the premiums paid in this particular illustration we're assuming that the premiums are all going to be paid in 5 years. So no more premium loads after 5 years. And then also in this particular illustration, the assumption is the per thousand charges only ran for a 10-year period, and then there were no more per thousand charges. So you've got the per thousand charges that stop at the end of 10 years. You've got the premium loads that stop at the end of 5 years. All that's left when you get into the 11th year is the policy fee and the COIs, or the mortality expense. That's why there's that big decrease in that year. Note that the difference between the mortality charges in the 13th year, 693, and the 14th year, 770, it goes up. Why was the mortality charge going down from 2,700 to 1,400 to 693, and then all of a sudden went up in the 14th year a little bit? The reason is, if we look at the death benefit, the way that this illustration, the way that the policy is structured, is that we started with a minimum death benefit of $930,000. We used a level death benefit option, but then we did something else. In the 12th year, we scheduled a decrease in the death benefit. So when we were running the illustration, we said, we want to start with $930,000. We want to keep it level at $930,000, but in year 12, we want to drop it down as much as we can. And in this case, we could drop it down to $643,000. And actually, in year 13, we could drop it down again to $543,000. Why would we drop the death benefit down? Well, a couple of reasons. One is we reduce the mortality charges. And what we're trying to do in this situation is we're trying to structure this as more as an alternative investment, where the death benefit isn't the primary reason that we're doing this. It's more, we're just trying to optimize the growth cash values. We are going to reduce the mortality charges that are deducted from those cash values if we reduce the death benefit. And so that's what you see happening here in the 12th year. Well, why did the death benefit go from $543,000 in year 13 to $580,000 in year 14? Why did it increase? Well, what that indicates to you is the policy now is in corridor. And once a policy reaches corridor, we've optimized it as much as we possibly can. Because now we're at a point, it looks like this. Our death benefit was level for the first 12 years, and then we reduced that death benefit. And ultimately, because this is a life insurance contract, the MEC rules are dictating there always must be a corridor of death benefit. So ultimately, the cash values will grow to a point where they would exceed that death benefit if there wasn't that corridor requirement. Since there is the corridor requirement, as the cash value account grows, which is what we're seeing represented by the green, the corridor of death benefit, what we're seeing in red, that's always going to be on top of that, and there'll always be a cost of insurance associated with that. Okay, isn't this a lot? Let's look at the 10 years, the first 10 years of loads, fees, and charges in this contract when they're the heaviest. And then the question is, man, isn't that a lot of money? I mean, look at this. What we did was we paid $250,000 of premiums, and $85,000 was deducted in loads, fees, and charges. Isn't that a lot of money? Well, again, the question is, compared to what? Well, let's look at this. You pay $250,000 in. Your total fees and charges over the first 10 years, when they're at their heaviest, is $85,000. That is a lot. How much is that? That's 34%. 34% of what the client paid, the $250,000, was deducted out in loads, fees, and charges. That's a big number, right? No question. But think about this. Let's say that $250,000 grows to $1,250,000. Somewhere down the road, we've got a cash value account in this policy that is now worth $1,250,000. Or there is, in other words, we experienced a gain over and above what the client paid into the contract of $1 million. What are the taxes on that $1 million gain? Well, this is a life insurance contract, and if the client handles this life insurance contract properly, there will be no taxes paid, no income taxes paid on that $1 million gain. Well, what if instead of the client putting $250,000 in this contract, what if they put that $250,000 in some alternative investment that did not have that tax-favored treatment that we get with life insurance? What if they put it into a taxable vehicle and we had a gain over a period of time, same gain of $1 million? Now that entire gain would be taxable. And if this client was effectively taxed at a rate of 34%, that's $340,000. Now, is 34% a reasonable assumption as to the future taxes? Who knows? I know in California, where the state government is crazier than the federal government in Washington, and we've got such huge deficits right now, that when you add up the federal tax to the state tax, I think 34%, there's a lot of people that looked at it as a bargain. Man, if I can get away with only paying 34% in total taxes, that's great. So think of that. If we're not using a life insurance contract and we're using an alternative and we get $1 million gain, you're going to pay $340,000 in taxes. Talk about expensive. $340,000. I mean, I'll pay $85,000 all day long if the alternative is that I'm going to instead have to pay $340,000. So is life insurance expensive? Yeah. But compared to what? Everything is expensive, and things that are taxable are really expensive because not only will you have to pay taxes, but you also will typically have loads, fees, and charges and other things as well. Now, when we're showing a client an illustration, what we're often dealing with too is the surrender fees, and that's the surrender charges in these contracts are often looked at as being expensive. I don't look at them that way, and maybe the reason that I don't look at them that way is that because I came out of the annuity world, and when I looked at the surrender charges in the annuity contract, that's what I consider expensive. So again, compared to what? Are the surrender charges expensive in an IUL contract compared to an annuity contract? Not at all. And here's why I'm saying that. Let's look at what's going on with regards to surrender charges in this IUL contract. The client pays $51,464. The projected accumulated value, not guaranteed, but the projected accumulated value in the contract is $45,886. But that, of course, is not the surrender value. There is a surrender charge. So if you're talking to a client, you're saying you pay in $51,000, you've got an accumulated value of $45,000. Where'd the other money go? Where'd the difference between the 51 and the 45 go? Loads, fees, and charges, right? That's where it went. But can the client pull out the whole 45,000? No. What the client can do is the client can pull out the surrender value. The surrender value in this contract is $18,061. So it's not the accumulated value, of course, it's the surrender value in the contract. What you may want to say to your clients as you're going through an illustration, you may want to say to them, look, before we go any further, if you're going to open up this contract, if you're going to start an IUL, and you're going to cancel it in the first year, man, I'm not your guy. I don't want to do business with you. You don't want to do business with me because this is going to hurt you if that's what your intent is. But I know you won't do that. I just want to make sure that you understand how severe it can be if in fact you did do that. Okay. What's the difference between the accumulated value and the surrender value? That's your cost for liquidity. That's what it is. Everything has a cost. Every product has a cost for liquidity. And if you look at the cost of liquidity in the IUL contract, it's pretty darn reasonable because here's really what's going on. In the first year, you put in $51,000 and you only had $18,000 liquid. But what happens in the second year? In the second year, you put in another $51,000. How much of that second year's $51,000 is liquid? The first year's premium was already gone, and there was $18,000 liquid with that. You pay another $51,000. Of that $51,000 paid in the second year, how much of it is liquid? Well, you've got an accumulated value of $95,000, and you've got a cash surrender value of $69,000. Your entire second year's premium is liquid. In other words, if you add $51,000 premium that you paid to the $18,000 of surrender value you had at the end of the first year, the total is $69,000. How much cash surrender value is there at the end of the second year? It's $69,567. So the point is, that whole $51,000 paid in the second year, every penny of that was liquid when we look at the surrender value at the end of the second year. All these contracts are going to vary in terms of when that's going to happen and how it's going to happen, but they're all generally the same in that your first year's premium is where you're going to see the biggest hit in terms of liquidity. And then the premiums from that point on are really relatively liquid. And then when you get down to when you're at the end of the surrender charge period in the contract, in this case, in 11 years, now the accumulated value and the surrender value are exactly the same. And now all of your money in your accumulated account is 100% liquid in the policy. Again, you compare this to an annuity, I don't think there's a comparison. These products provide our clients with an awful lot of liquidity. Okay. We're now in the 11th year of the contract. We've gotten rid of, or we've gotten through the premium loads, and we've gotten through the per thousand fees in the contract. All that's now left for our clients to have to deal with in terms of cost are the mortality costs and the policy fee. All the heavy loads and fees are taken out of this contract, and now all our clients are paying for those mortality expenses of the COIs. Let's look at that. What is the COI in this contract? What's being deducted for mortality charges in the 11th year? It's $2,642. We have a $72 policy fee, and the total that's being deducted in the 11th year from the cash value account to cover all of the expenses that year is $2,713. Let's compare that to the amount of cash value that's in the contract, non-guaranteed projected cash value in the contract in the 11th year. It is scheduled to be or projected to be $367,684. And let's look at the total charges as a percentage of that cash value. What percent of $367,000 of cash value is $2,713? It's less than 1%. In other words, it's about 74 basis points, 74 bips. Think about this. Your client's got $367,000 at work someplace. In a mutual fund, somewhere they've got that money sitting. What is the expense that's going to be deducted out of that mutual fund or out of that investment that year? And I'll tell you, it's going to be more than 74 basis points. It's going to be 1%, 1.5%, 2%, or higher. That's typically what people are paying in mutual funds and other investments on an annual basis. That same $367,000 of cash value inside the IUL product with a load or a fee of $2,713 is less money than what they would be paying if that money was sitting in a mutual fund. But not only that, think about this. What do they get for whatever they're paying in that mutual fund? Let's say 1% is being deducted. What do they get for the $3,600 that's deducted from their mutual fund account in year 11? Well, all you can pretty much argue is they're getting professional money management. A lot of people, we look at their mutual funds and they haven't performed all that well. So it's debatable as to what the true value of professional money management is. What's our client getting for the $2,700 that was their total fee in year 11? What they're getting is they're getting a life insurance death benefit. That's what you're getting for the mortality charges. Now, let's look at the growth in cash value between the 10th year and the 11th year. What is projected in this illustration is that at the end of year 10, they have $341,000. And at the end of year 11, that's grown to $367,000. How much growth is that? It's $26,619 that is the projected increase between year 10 and year 11. That's a 7.8% increase in cash value. They have an opportunity, a reasonable opportunity, to see their cash value grow by 7.8%, and that is tax advantaged. There is the potential that that entire 7.8% will be income tax free. And their cost, what's being deducted to manage all of this, is 74 bips. Is life insurance expensive? I don't know. Compared to what? Again, what are we getting for that total expense in year 11 of $2,700? We're getting $930,000 worth of death benefit at that point as well. So it's not a pure cost. You're getting something in return for that. Now, I'll tell you, I think these contracts are magical. I really do. I mean, it's like, how in the heck does the insurance company, how are they able to do this? Certainly there are front-end loads of fees and charges. And those front-end loads, fees, and charges, yeah, they amount to a lot of money. Is that expensive? Compared to what? Most people don't have any problem in paying for something if they see value in it. And when we look at the death benefit, when we look at it in these contracts, the accelerated living benefits that we have available in a lot of these contracts to cover long-term care and other things, there's a lot of value there. And so you're paying fees at $2,700 a year after, when you get into year 11 and beyond, you're getting a lot of value for that $2,700.